Coface remains committed to provide you with relevant information regarding country, regional, and worldwide assessments based on macroeconomic, financial, and political data. Therefore, we put this panel together with our three regional economists. It is my pleasure to present from Asia Pacific, Carlos Casanova, who is based in Hong Kong, Ruben Nizard, based in the USA, and from Latin America, Patricia Krause, based in Brazil. They will share different views of and comment on challenges and opportunities in the light of the COVID-19 pandemic. Before we start, I would like to thank my colleague, Oscar Villalonga, CEO for Coface North America, for this joint event today and invite him to say some words. Again, thank you for your participation. And Oscar, please go ahead. The mic is yours.
Thank you, Carmina. Buenos dias. Good morning from the Americas. Very happy to have you join our conversation today. We're very fortunate, as Carmina said, to have a group of economists that cover the world, and they sit in each of our regions. So the insight you're getting today from our three chief economists for each of the three regions is invaluable to decisions that we're making as a company at Coface, and hopefully will help you make your decisions as you move forward in this uncertain world with a lot of volatility. You know, final thing I will say is that the insights that we're getting from our economists are the same insights we're using if you're a trade credit insurance company, a customer of ours, and if you're also a customer of our information services. We're taking these insights to make our decisions on limits and on to help our policyholders as we go forward. So without further delay, I want to introduce Carlos Casanova. Carlos, thank you for staying up late with us in Hong Kong, and you have the mic.
Thanks for having me today, and good morning, everyone. I hope you can hear me clearly. I'm a little bit further away, but nonetheless, I will try the best to speak out loud to make sure you can all hear me. I will start the discussion by introducing our global view, and then I will move on to our view on Asia with a focus on China, because I think that's the key market that a lot of our clients in the Americas will be looking at. First of all, I'd like to highlight that our quarterly barometer for the second quarter was released already. You can access all of this information on the website, and this time around, it's important to read the publication because we did implement a large number of revisions to a country and sector risk assessments in order to factor in the impact of COVID-19 on the global economy. Now, I will not go into each of the individual downgrades. I think we have our economists in North America and Latin America for that. But just to explain very briefly that this is a little bit different to what we see from the rating agencies. Moody's, Fitch, and S&P tend to focus more on medium-term risks for the sovereign outlook of countries around the world, whereas we look a lot more at short-term, between 6 to 12 months, risks for companies in these markets. So in other words, what you're looking at here is the likelihood that a company in one of these markets will default in its payment. So slightly different measure. We tend to be a lot more reactive than the rating agencies. And you can access all of this information, which is based on macroeconomic expertise, a comprehension of the business environment, and I would like to say also the political risk in the different regions, which can be quite relevant for some markets. And of course, all of the payment data that Coface has been collecting for over 7 years. So all of this information is already on the website, and I do encourage everyone to look at that. If we could move on to the next slide. The view for 2020 is going to be a little bit more negative than what we were discussing as part of the Q1 assessments. We are now expecting global GDP to contract by -4.4%. Again, you have the individual country forecasts in the chart on the right-hand side, but overall, the declines seem to be much more pronounced in developed markets in Europe and North America, with emerging markets, in particular in Asia, led by China and India, but also Indonesia and Vietnam, still growing positively in 2020. Now, our scenario assumes no second outbreak, so no second wave. Our baseline scenario assumes no second wave of COVID-19 in the second half of the year. And in that baseline scenario, we do see global growth rebounding in 2021 to 5.1%. Having said that, there are some risks. If you keep following the news lately, there were more cases in Beijing in the last few days. So there is a chance that we might converge towards the risk scenario. For the purpose of this conversation, we have not included our forecasts for a risk scenario, but there is a chance that we might converge to a risk scenario, in which case that 5.1% expansion in 2021 will look too positive. That's just something to keep in mind. However, in line with our baseline scenario, if we could move to the next slide, we do expect to see an increase in business insolvencies around the world. Different markets will have different rates of increase depending on the severity of the lockdown measures, the impact on the economy, and whether the countries had existing underlying fragilities or not. But overall, we are looking at a much larger figure for the combined period of 2020 and 2021, with global insolvencies increasing to 33%. The reason why we decided to combine 2020 and 2021 is that we are not going to see the increase in insolvencies, the increase in claims, and the increase in notifications of overdue quite yet. And the reason for that is that you have a number of economies around the world. India is an example, China is an example, Hong Kong. In Asia, I'm sure, our Latin America and North American economies can comment on the economies as well. But a number of governments have introduced measures to ensure there's enough liquidity and to ensure that companies have a little bit of wiggle room to manage the worst part of the pandemic, which is now seems to be behind us for most of the countries, but not all. And that includes measures like moratoriums on bad loans of more than 6 months in some cases. So it's going to take a little bit longer before we see the insolvencies materialize. Maybe by Q3 or more likely Q4 this year and the first half of 2021, we will see that uptick in insolvency. So that's why we decided this time around to combine 2020 and 2021 figures into one. So that this is the picture that you are seeing in this chart. Moving on to Asia, if we can look at the next slide, we are expecting to see growth in some regions, but most of the countries in my region will also face a contraction in 2020. A big factor driving this contraction is, of course, domestic demand. Some markets have implemented lockdown measures and has dragged down on domestic activity. But the reason why some countries are performing worse than others is because they are more exposed to trade and external demand and the source of tourism revenue. So those two engines of growth are definitely not going to be there in 2020. We've already seen a decline in trade across the region, and that's going to translate into weaker activity for economies such as Thailand, with tourism revenues accounting for almost 20% of GDP. New Zealand, Hong Kong, which is an important re-export hub of Chinese goods to the rest of the world. But Hong Kong is also experiencing its own triple whammy, like I call it, of protests, the COVID-19 and the US-China trade war impact on the exporting sector. So Hong Kong definitely going to experience some pressures. Singapore as well, also compounded with weaker oil prices. Singapore is an important oil trading center for Asia Pacific. In Japan, we were expecting to see the Olympics providing some support behind domestic consumption, but that is not happening. So for Japan, we do see some weakness again in 2020. And then towards the left-hand side of the chart, in China and Vietnam, they were able to implement measures to contain this virus very quickly. They also have strong government structures that are able to implement stimulus as well, so that is helping these economies to grow faster than a part of the region. I would like to highlight that in India and Indonesia, we haven't seen the number of COVID-19 cases peak yet. And so it is possible that we will see further downside pressure on those two markets. It's something that we are monitoring at the moment, and we are keeping a close eye on India and Indonesia because we do feel that the situation could deteriorate in those two markets. In particular, in India, the domestic consumption accounts for more than 60% of its GDP, and the number of cases seems to continue to increase. So it has a potential source of risk as well. But over the board, China, Vietnam, Indonesia to some extent should continue to provide some growth. If we can move on to the next slide. We, in line with what we were saying, with risks piling for a lot of the countries in Asia Pacific, that also translated into downgrades for sectors. We did implement a series of downgrades that were synchronized for all of the regions, and you will see this slide in the presentation of my fellow economists as well. In particular, the automotive sector is heading into a very difficult 2020, but they're coming from a position of weakness because auto sales were negative in a lot of the key markets in 2019 and 2018. Transport, of course, is a sector that was very directly impacted by the impact of COVID-19, together with retail. So in a lot of regions around the world, we implemented synchronized downgrades for those sectors as well. Construction, very high risk for a lot of the countries in Asia in particular, where we have very high levels of debt concentrated in that sector as well, led by China. And then we also, in addition to the COVID-19 impact, we look at each sector on a sector-by-sector basis. So for example, in Australia, we decided to implement downgrades on the agri-food sector for two reasons. First of all, the sector was subject to headwinds surrounding the bushfires in January this year, but also the sector has been tangled in the US-China trade war, and China started to target Australian exports of agri-food goods, which of course is going to translate into a headwind for the sector going forward. So it's a combination of this global impact of COVID-19, plus also specific factors that change on a sector-by-sector and a country-by-country basis. Now, moving on to the section on diverging trends in my presentation, we are seeing a very gradual recovery in a lot of the countries around the region. If you can move on to the next slide, you will see that in particular, China was the first country to experience that decline in activity. This is the Purchasing Managers Index, which is a measure of sentiment in the manufacturing sector. In a sense, it's a proxy for manufacturing activity in a lot of these countries. In China, of course, was the first country to implement local measures, the first country to see a sharp contraction in manufacturing. Anything below that watershed level of 50 signifies contraction, and anything above the line is expansion. But they were also the first country to rebound, and we're seeing the PMI hovering over 50 the past 2 months. This is, it varies greatly in Asia Pacific. Some countries were able to, restart their economies sooner, but we are seeing declines in a lot of the markets still, led by Indonesia and India, where we have seen a pickup in cases in recent weeks. So again, diverging trends also in Asia Pacific, with China, Japan, South Korea, Taiwan, Vietnam leading the pack, and then some of the economies in Southeast Asia still looking to go through the worst patches of the coronavirus outbreak. Another thing that we can look at is, of course, if we can move on to the next slide, please, is migration, transportation, and this is a proxy for consumption. We could have also shown you the Google retail index, but generally speaking, if people are able to move around and travel around and also able to consume. So we can see diverging trends as well here. We don't have China because it's data for Google, but the situation is analogous in China as well. Vietnam and South Korea are already almost back at the levels of transportation that they were before the impact of COVID-19. In Taiwan, the situation is a little bit more subdued, but again, we do see some upside pressure as well. Hong Kong was doing fairly well until June, because we've seen an intensification of protests here. We've had protests almost every weekend since the beginning of the month. So that has led to a decline in transportation and people moving around, and it's going to continue to drag on the economy. But elsewhere in Asia Pacific, we are still far behind. And even in markets where COVID-19 has been eradicated, like in New Zealand, we are still significantly below the pre-COVID-19 level. I want to use this as an opportunity to highlight that despite we're talking about a weak recovery, despite we're looking at indicators edging up again, And even assuming a rebound in global GDP in 2021, the figures are going to look very good because we compare one year with another. But if you look at the GDP level in billions of US dollars, or if you look at the amount of revenue for some of the companies in these sectors or in these countries, it's still going to be lower than what it was in 2019 and 2021. So it's a weak recovery. It's a recovery from a weak base, and so we do not expect to see things go back to normal anytime soon. But we are starting to see some improvement in some indicators, especially for countries in Asia Pacific that experienced this before. So having said that, I will finish with some of my China slides before handing over to the other economists. The next slide is, I guess, what a lot of you have been looking forward to, which is our China outlook. In line with what I just said, we expect a weak recovery. We are seeing an indication that that's already happening. In particular, the activity trackers that we follow on the right-hand side showed industrial production picked up in April, and May figures were released overnight. And it's consistent with this picture. So there was a moderate recovery in industrial production. A lot of it is related to pent-up demand. In China, factories were closed. Orders piled up, so the China factories opened again with an increase in demand. That's not going to be sustainable going forward. So we do not expect to see industrial production being very contractionary like it was in February and March. Retail sales are also improving. However, they're still negative. They were still negative in May. And they were, in the first 5 months of the year, they were negative minus 12%. So it's almost negative 10% in the first half of the year. It's going to be very difficult for China to achieve an increase in domestic consumption at all in 2020. So that's going to drag on activity, and it's also going to drag on exports from a lot of the countries in the Americas that are very dependent on Chinese demand. We do not foresee an increase in Chinese consumption going forward, despite there being quite a number of things to stimulate the economy. In fact, our current baseline scenario assumes a minus 2% contraction in Q2, and then a very gradual recovery in the second half of the year. But that is assuming that there is no second outbreak. In case of a second outbreak, it will only be converging towards a risk scenario, which is a little bit more negative. Of course, this weakness in activity is translating into weaker domestic demand and deflation in China, which is starting to export to other parts of the world. If we can please move on to the next slides, you will see on the left-hand side that China consumer prices and producer prices remain subdued. On the next slide, please. On the left-hand side, you will see that the CPI, the consumer price index, and the producer price index, which is the PPI, continue very subdued. Consumer prices are not weaker than they are because last year we had an African swine flu pandemic in China that was had a very disrupted the domestic supply chain in China. It's been good news for exporters such as Brazil because they've been able to increase exports of meat to China, but it's kept consumer prices artificially high. In line with the stabilization in domestic supply chains in China, we are seeing that consumer price inflation edging down quite quickly. And of course, if we have negative growth in China in the first half of the year, we would expect to see deflation as well. CPI inflation and producer price inflation, and that's related to everything happening in the manufacturing sector, remains very negative. What that means is that we have excess capacity in many cases. The metal sector is a good example. We saw capacity utilization rates dip below 70% for steel, iron ore, and other metals. And that is exerting downside pressure on prices as well. So whenever you have more supply than demand, you have downside pressure on prices. So that's what we're seeing with that contraction in producer price inflation. In China, when producer prices go down, that also has a lagged effect on profits for Chinese companies. As you can see on the right, there is a direct correlation between producer prices and industrial profits. It smooths things out a bit, so this is a 3-month moving average. But we do expect to see industrial profits to continue to be very negative. They were almost minus 18% last month, so we do expect to see a continuation of that going forward. So if you do have exposures to China, the Chinese industrial companies understand that because of this deflationary domestic environment, they are going to be experiencing an increase in pressures on the profitability front as a result. If we can move to the next slide, the good news is that China did announce that it was going to do a lot more stimulus. However, this time around, this year, it's going to be different to other years. They completely dropped their GDP target in the National People's Congress a couple of weeks ago, and they are focusing instead on stability or ensuring that the employment rate remains at around 6%. In fact, it went down a little bit. The data was also released this month. It went down this week. It went down a little bit from 6% to 5.9% in May. I don't know if that is entirely true or not because China has its own way of computing on the unemployment rate. But they are going to do a lot of policy stimulus, but they are not going to be focusing on growth at all costs like before. It's going to be a lot more targeted. On the credit growth front, you can see that outstanding credit growth has increased quite a bit and is almost up to 13%. We do expect to see outstanding credit growth increase a lot more. In 2016, when China experienced capital outflows as a result of the devaluation of the yuan, credit growth, we had to ramp it up to approximately 16%. So we do expect that that will continue to edge up in 2020, especially if things make a turn for the worse. However, if you look at the components of that credit boost, they are focusing on the sort of on-balance sheet parts of the equation, and they're trying to keep shadow banking, which is a source of fragilities because it's harder to control for the central government. They're trying to keep shadow banking under control. So they're not ramping up stimulus like crazy. And on the fiscal front, if you look at the chart on the right, you will see that the targets for 2020, they announced a 40% increase in government bond issuance. They announced that the fiscal deficit target is going to increase by 3.6%. And they also announced for the first time in many, many years that they were going to use special off-budget bonds as well. This does not take into account, of course, all of the off-book government stimulus, all of the spending by local governments through the issuance of local government financing vehicles, for example. If you take all of that into account, we're looking at a much bigger fiscal deficit of around 10% of GDP in 2020. So this is good news. This is supportive for demand of commodities in Latin America, for example, or even technology and electronics from the USA. However, they are not going to focus on rail, road, ports, and airports anymore because China has a problem with non-performing assets. China has a problem with the quality of the debt that they are generating. Instead, what they're going to try to do is to focus all of the infrastructure spending on key infrastructure for the future. That means building all of the country's 5G infrastructure. That also means building additional data servers and tech-related infrastructure, and also providing enough support for companies to develop what they call special materials, which is everything related to semiconductors. So they are going to try to focus that infrastructure spending a lot more, and the multiplier effect on demand for metals and demand for copper is a little bit weaker than it was in the past. So don't expect this to translate into a lot of demand from China, but it is nonetheless good news in the context that China is trying to maintain that unemployment rate stable. But it's not going to be growth at all costs. I have on my next slide some figures for China trade, and I could have shown a chart of Chinese exports and imports and how that's changing going forward, but I think we all understand that there is a global recession and that Chinese exports are in negative territory. Ruben will also share a few slides on the US-China trade war, so I didn't want to share more information on the US-China trade war either. So I chose instead to look at trade with Latin America. When I was working at BBVA, it was at the time, it was around 2016, when Chinese demand was starting to falter. So we looked at the dependency of Chinese demand for some of the main commodity exports in Latin America, and I have to say that the situation hasn't changed dramatically since. It's a structural narrative, and so that dependency remains in place. What I've looked on the left is the top 3 exports of the top 3 exporters. So the top 3 countries that export to China, Brazil, Mexico, and Chile. And I've looked at the top 3 exports as a proportion of total exports to China. And you can see that it's still very concentrated on a few products: soy, mineral fuels, and ores, and metals. So with ores, I include copper as well in the case of Chile. So metals, mineral fuels, and soy are 3 key exports to China. And these countries will remain very dependent on Chinese demand. As the Chinese economy is expected to contract in 2020, we do expect to see a decrease in demand for these commodities from China naturally. On the agri-food front of things, we haven't seen that yet for 2 reasons. First of all, is that there was a disruption to the domestic supply chain, so China had to import more food from other parts of the world. That includes meat, which, by the way, meat was the 4th largest export from Brazil to China, accounting for 7% of Brazil's total exports to China. But also soya. So soya is a big component that goes into the production of meat in China, and they had to try to lower the cost of meat in the domestic market by importing more from other parts of the world, including feed. And so that's helped Brazilian soy exports to China. It's also the soy season in Brazil right now. So typically in the winter, they import from the US, and in the Q2, which would be the summer season in the Northern Hemisphere, they import soya from Brazil, Uruguay, and other parts of Latin America. So that is a factor that is just related to weather. It's nothing we can do, but that demand might start to falter as we go into the second half of the year. And same with metals, because that infrastructure push is not going to focus on railroad. We are going to see an increase in demand, but it's not going to be as high as we have witnessed in 2008 or even in 2016. We also see Brazil having some degree of exposure to financing from Latin America. It's the 2nd largest recipient of state-to-state financing in Latin America, and these are figures compiled by the Inter-American Dialogue in DC. So sometimes they do miss a deal or two, but overall it's fairly accurate. Mexico is a far smaller recipient of state-to-state financing. So I think in the case of Brazil, there is a vested interest to try to keep the relationship going. That is good in times when China is doing a lot of stimulus, but it might be tricky because, as we've seen in other parts of the world, in Australia is a great example. The deteriorating relationship between the US and China might mean that you have to pick sides, and Brazil might find itself in a bit of a crossroads here when you have to juggle their relationship with the United States and also China, and both countries, I believe, are very important for Brazil. So this is something to keep in mind going forward. 2 more slides before I hand over. Our China payment survey was released as well this month. And in this survey, what we do is we look at the payment behavior of Chinese firms. We compile all of this data in the last quarter of the year. So what you're looking at here is the payment behavior of Chinese firms in 2019. But there is, it is important because there is a correlation between what we see companies responding and then what happens in the real economy in the months to follow. And unfortunately, we saw a deterioration in payment delays in China in 2019, even before the coronavirus outbreak had a very big effect on the economy. So here, what we are displaying is a very important indicator, in my opinion, which is the ratio of companies reporting that they have ultra-long payment delays. Those are delays exceeding 6 months on top of whatever credit terms you sign with the buyer, accounting for more than 10% of annual turnover. So you can imagine if you have a credit terms of 3 months and you have payment delays of 6 months, the buyer hasn't paid you in almost a year or 9 months, the likelihood that they will pay at all is very low. So when you have a significant proportion of your turnover tied up in these ultra-long payment delays, a company experiences cash flow risks. So they have to seek financing from other sources, be that from the bank, extending a loan, or other sources of financing. So the proportion of respondents claiming that they had more than 10% of their turnover tied up in these long delays increased to 27% in 2019, and that is before the coronavirus outbreak. So we do expect to see a lot more pressure going into 2020, and a few of the sectors are unfortunately going to head this storm from a position of weakness. More specifically, if we can move on to the next slide, The sectors where we saw a lot of cash flow risks piling in 2019 are the construction, the ICT with everything surrounding the US-China trade war, the energy sector, which is historically one of the highest leverage ratios in China, transport, which again has very high debt, a very high debt ratio, but also it's worrying because the transport sector is very directly impacted by the COVID-19 outbreak. Paper, and I would also like to highlight that automotive is also high risk if you look at some of the other indicators. So these sectors are going into this period of uncertainty from a position of weakness. So if you do have exposure to these sectors, you can expect to see an increase in payment delays or even insolvencies from the Chinese companies in the coming months. This is it from me. I will stay for the Q&A session as well in case you have any questions. For the time being, I will hand over to my colleague Ruben.
Good morning, everyone. I hope you're doing okay in this time of COVID. Thank you, Carlos, for your presentation and the outlook for Asia. So I will move on to the outlook for North America, which has been hit quite hard by the COVID-19 pandemic. So before I move on to the economic scenario, I just wanted to make a quick reminder of the sanitary situations in North America, because some of you might not be familiar with the situation. So in North America, the outbreaks of COVID-19 started a bit later than in Asia. So mostly you can see it started to take off in the second half of March, and it forced most US states to impose stay-at-home orders from the end of March up until the end of April, early May. What you can see from this chart for both the US and Canada is that the number of COVID-19 related deaths is on a downward trend, and that it seems that at the national level, the trend is suggesting that the peak of the first wave is behind us. But with that being said, it's important to remind that well, US and Canada are two very big countries, and there are very diverging trends within these countries that are going to have an impact on the recovery and on the speed of the recovery. So more specifically, when we look at what's happening in the US currently, we can see these diverging trends quite clearly with these charts. So I just compared the average number of cases in the past week to the number of cases 2 weeks before that. And you can see that almost half of the states in the US are seeing a rise in new cases, suggesting that not only the first wave might not be over, just like in California, where we've seen almost an uninterrupted rise in the number of new cases over the past month, but also in some states, and it's a bit more worrying, and it's probably going to delay the reopening process from the shutdown that has been forced because of COVID-19. We're seeing a second wave. So it's, for instance, the case in Florida, where you can see there's an increase of about 1.2%, suggesting that there are about 2 times more cases. There were about 2 times more cases last week than 2 weeks prior to that. So it's important to look at it. So even if, when we look at the overall figure for the United States and Canada, it might look more favorable. It's really important to have these diverging trends in mind, because they gonna impact the recovery, and it's impacting some of the biggest U.S. states like California that I mentioned, Florida that I've also mentioned, but also Texas, where the number of cases are also rising, and it's gonna delay the reopening process. There are some better news, and the overall trend of stabilization of the outbreak is mostly driven by the 2 worst hit states so far, the New York State and New Jersey, where the number of cases are declining quite rapidly. But even though the northeastern region seems to have the first wave behind, that might not be the case for some southern states and some states on the west coast. So as I mentioned, the COVID-19 outbreak forced many states to implement stay-at-home orders. These stay-at-home orders meant that the economy was on freeze for about a month and a half, for about 6 weeks in most part of the US and Canada. But with that being said, it's important to note several factors about the shutdowns in North America. And I think it's important, this chart shows it quite well, is that the shutdown in North America was probably less stringent than in most European countries and in most Asian countries, and that it was also shorter. So basically on the horizontal axis, you have the average of a stringency index that is calculated based on the policy response of governments, looking at stores closures and schools closure and measures being implemented, and they rank it from 0 to 1 to 100, and the closer you are to 0, the less stringent the lockdown is. The closer you are to 100, the more stringent the measures were. So you can see that there's a close correlation between the lockdown, the freeze in the economy, and the GDP growth that is represented on the vertical axis. And you can see that USA and Canada, which are represented here in green, are mostly on the left-hand side, suggesting that it was less stringent, having a less deeper impact than in some European countries, at least in Q1. But the impact, even though the shutdowns were shorter and less stringent, is already having a very deep impact. So you can see from the chart on the left-hand side, the GDP growth over the past 3 years, and you can see that for the first time since 2014, Canadian and US GDP declined. So Canadian GDP is represented in red and US GDP in blue. And they contracted at their fastest pace since the Q4 of 2008, so since the great financial crisis. Our scenario is based also on the assumptions that the contraction in GDP will be even sharper in the second quarter, with both economies expected to contract at an annual pace of about 33% in the second quarter. And even though we expect a recovery in the second half of the year, the overall figure for year 2020 is going to be negative for both countries, and it's going to be the worst. We are forecasting the worst contraction ever for these both countries since World War II, with a minus 5.6% GDP growth in the US and minus 6.1% GDP growth in Canada. As Carlos mentioned, we do expect a recovery in 2021 and positive growth to return in 2021. So in the US, we forecast 3.3% growth in GDP, and in Canada, we forecast 4.5%. But these figures for 2021 both means that the US and Canadian economy will have lower GDP levels by the end of 2021 than they were at the end of 2019. So showing the very deep impact of this crisis and of this great freeze, the great shutdown on overall activity. I think that one very important feature as well of this crisis and of the great shutdown in North America is the impact on the labor market. The labor market and employment has been affected in a way that no other country, at least in Europe and in many European countries, has been affected, with unemployment levels rising to record levels. So you can see that in May, the Canadian unemployment rate jumped to an all-time high of 13.7%, and in the US, it was still standing at 13.3%, which is still far higher than the peak reached in the previous crisis, which was at 10%, and it's still the highest unemployment rate since at least the Great Depression in the 1930s. So it shows how these two charts, they just show how deep the impact was on North America. And I think the one on the right hand side is very important because it's going to have an impact and is one of the aspects why we expect a slow recovery to take place in North America. So this recovery is going to be slow. It's underway, so that's the good news. The latest indicators that were released indicate that the worst of the crisis might already be behind for North America. So on the right-hand side, you have the Purchasing Managers Index, so the survey tracking economic activity in the world. You can see that in the U.S., this composite PMI driven by the services sector plunged to a record low at about 27, suggesting one of the sharpest recovery on record for these indicators. But in May, it started to recover around 36. So it recovered quite sharply, but from, as Carlos mentioned, it's from a very low base. And also what is important to mention is that all these lines are still below the red line, suggesting that even though the economy started to rebound in May with the economy reopening in many states and provinces and territories, the economy was still in contraction in May. And that's why, the reason why we're expecting such a deep contraction in the second quarter of 2020. When we're looking at higher frequency indicators, we also have this evidence that the recovery is very gradual. By looking at the mobility trends in the US and Canada, and more specifically in retail and recreation, we can see that foot traffic in these places remain almost now a full month after the easing of some restrictions measures were implemented in some US states and Canadian provinces. You can see that it's still 20 to 30% lower. I also added the foot traffic in transit stations to show you that that even in some aspects, the recovery is going to be very even slower than for retail. And you can see that for traffic in transit stations, it's struggling to recover, and it will probably take at least 12 to 18 months to have a return to the pre-COVID-19 baseline and the pre-COVID-19 situation. So that's this recovery is underway. So the worst might be behind us. We have these diverging trends, but the problem is that this recovery is going to take some time. So to support this recovery and to cushion the blow of the Great Shutdown, some unprecedented measures have been taken by the U.S. and Canadian governments. So on the fiscal side, so you can see on the left-hand side chart, the U.S. CARES Act, which is the main piece of legislation passed by the U.S. Congress to support the economy. In the U.S., these fiscal measures are worth about a total of about 14% of the U.S. GDP. In Canada, it represents about 9 to 10% of GDP, these fiscal measures. And they are primarily giving support to businesses to keep employees on the payroll and to avoid that the sharp rise that I've showed in unemployment rates stick for longer and is having an impact on consumer-driven economies like the US and Canada. In addition to loans supporting businesses, so that's small businesses to keep employees on the payroll, and a FED program that aims at also at providing loans to bigger companies. There are also some measures targeting households that are very important. So it's expanded unemployment benefits to make sure that that the income of American households are not too much, do not fall too much, and also some payments made directly by check to American households to support consumer spending. In Canada, the measures mostly the measures are pretty similar. We're also having the support to businesses through loans programs and rent relief, so to help businesses keep employees on their payroll. The main difference is that we're not having these direct cash payments to households, and also the Canadian government has not yet unveiled targeted measures for distressed industries like the US did, for instance, with the airlines, with grants and loans to the airlines that were very specific and more targeted. In addition to the fiscal policy measures, we're also having an unprecedented response on the monetary policy side. So both Canada and the US cut their interest rates to record lows near zeros. So they're back to the level that they were a decade ago after the great financial crisis. And also both central banks implemented very rapid and very aggressive asset purchase programs to make sure that the financial markets keep some liquidity and to avoid a credit crunch in the economy. And you can see that it's very aggressive with the Federal Reserve balance sheet that has swelled over the past 2 months, and with the Federal Reserve balance sheet swelling to $7.2 trillion US. So it's about a third of the US GDP, showing the magnitude of the policy response being implemented. But it's less difficult to see the result of the monetary policy measures, but we are always seeing some evidence that the fiscal policy measures are providing some supports to income. So that's some of the good news. So that's what you can see on the left-hand side chart. So this is the change in personal income since the month-on-month change in personal income since the beginning of the year. And you can see that in March, as the shutdown started and as the crisis started, wages and salaries started to contract quite sharply, driving down personal income by 2%. But in April, it's quite surprising, it rose by more than 10%, income rose by more than 10%. And it's been mostly supported by these fiscal policy measures with this green bar that is called government social benefits to persons, and that include the expanded unemployment benefits and also the one-off cash payments to American households. But the thing is that wages and salaries continued declining, and it's a worrying signal for the rest of the recovery, because the government social benefits to persons are temporary measures. And by the end of July, most of these government supports is going to end, and it's not very clear what will become of the income of US households. And it's bodes ill for consumer spending that has been suffering because of the lockdown and because of the uncertainty. You can see on the right-hand side chart that already the personal saving rate in the US has jumped to an historic high of 33%, because people, even though they saw their income increase, were quite reluctant to spend in April because they were cautious, because their financial situation was uncertain, and also because obviously a lot of places were still closed. And most of the scenario will depend on how much the households, American households, will tap into the savings in the next few months. But in our view, they're probably going to remain cautious. Why is that? It's because, as I mentioned, the impact on the labor market has been very deep, and is probably going to impact aggregate income of U.S. households for the foreseeable futures. And it's the economy, North American economies are going to take a lot of time to recover from the shock of COVID-19. So on the left-hand side chart, you can see the cumulated change in unemployment since the beginning of the crisis in the US. And you can see that it's a total of 19.6 million jobs that we have 19.6 million jobs fewer than before the crisis. So that's why the unemployment rate in the US jumped from a 50-year low to a 90-year high in the span of just 2 months, so from 3.5% in February of 2020 to 14.7% in April of 2020. So it's definitely a shock that the U.S. labor market will take a lot of time to recover from. And as I mentioned, the diverging trends that we're seeing on a state-by-state basis mean that the return to work for some employees is going to take even more time. And even though we've seen some kind of turnaround in May with an increase of 2.5 million in jobs, it was mostly people returning to jobs in the economy's reopening, and it's unlikely that the 10% losses that we're going to recover the 9/10 of the job lost because of this crisis as fast as they were lost. So that's definitely a worrying signal for the recovery. And one of the other worrying signals on the labor market is that even though in May the number of jobs increased and people returned to work, we can see that permanent job losses continue to increase at a very fast pace. So just to give you an idea, the rate of 295,000 permanent job losses is about the average that permanent job losses that were recording during the last great financial crisis. And because the level of activities, and we forecast that level of activities will remain lower than they were before the crisis, we believe that permanent job losses will increase, even though some temporary layoffs that were conducted in March and April will probably translate into permanent job losses. The other very important aspect as we reopen for the recovery will be what has been the main topic of discussions in economic policy over the past 2 years, the US-China trade war, and that might also impede the recovery. So as you can see on the left-hand side chart, well, you can first see that the escalation in the US-China trade war over the past 2 years. In the past 6 months, the topic has been a bit more quiet. First, because of the phase 1 deal that has been signed between the US and China. That was kind of a detente in the trade war that has been taking place in the past 2 years, but also because of the COVID-19 pandemic that has put the topic of trade war in the back of the headlines. But as the economies are reopening, the topic is very much back in focus, and we've seen escalating tensions again in May and June taking place in between the US and China. So interestingly, these tensions are both on the trade front, because, well, you can see from the right-hand side chart that China is struggling to meet the commitments made with the phase 1 deal, and that they will probably fail to meet the targets set by the phase 1 deal. So that's one aspect. But the US administration's accusation that China was responsible for the COVID-19 pandemic is also prompting further strains on relations, and other policy topics are also putting a lot of strains on the relations. And we've seen in May the US impose some sanctions on Chinese firms, on 33 Chinese firms that will notably that will notably put pressure on purchase of U.S. goods, and we will probably see in the next 6 months, as the economy reopens and as the U.S. moves towards the presidential elections, more of these sanctions, and that might be the new phase of the trade war, not so much on the tariff front, but more on the sanction front, and that will have a deep impact on the recovery and could slow further this recovery. So what is the impact of this scenario on businesses? So as Krause mentioned, we're expecting a very sharp rise in unemployment in all over the world, and it will be very much the case in the US as well. Already in the first quarter, business bankruptcy filing increased by 6%, and another database with higher frequency data suggests that commercial filings continue increasing in April and in May, rising by as much as 48% year on year in May. And this suggests that the bankruptcy movement is gaining momentum, and that we will going to see an increase in business bankruptcy filings as the economy moves towards the reopening. And as Carlos mentioned, we did not see a sharp rise. The worst of the rise in bankruptcy might not be during the Great Shutdown, but might be seen in the rest of 2020, and probably in the second half of 2020, and also at the beginning of 2021. So for the US, we are forecasting that by the end of 2021, we will have 43% more business bankruptcy filings than in 2019. So which sectors are going to drive these increased business bankruptcy filings? So the first one is going to be retail. So because of the stores closure, it has triggered a loss in revenue that is unprecedented for many retailers that were already struggling with a lot of debt, and we were already seeing a trend of rising bankruptcy in the retail sector. So you can see here that in April, retail sales declined by more than 10%, and we expect these retail sales to remain slow in the coming months because of the strain on American incomes. So it means that the impact on revenues will make liabilities of retail companies more expensive, and that will probably push a lot of them into bankruptcy. Already we've seen big retailers file for bankruptcy, just like, for instance, Neiman Marcus, JCPenney. They have filed for bankruptcy amid the COVID-19 pandemic, and we can expect more to come with a lot of retailers that have announced stores closures, and in the bid to try to mitigate the impact of this crisis, but it might not save them from bankruptcy. Another sectors that has been very deeply impacted and that will take probably longer than the rest of the economy to recover is transport, and particularly air transport. So you can see from this chart on the left-hand side that the numbers of travelers going through security checkpoints is on demand. So that's a positive development, but it's still 20%. It's only 20% of the levels of passenger that were going through the security checkpoints in 2019, and it's probably going to take years before we go back to the number of passengers that we had in 2019. The reason is that travelers are going to remain cautious because of social distancing measures. Airlines are probably continue to implement social distancing measures, reducing seat capacity. So that's why we're expecting a slower recovery. And we've already seen some major airlines file for bankruptcies all over the world. For instance, Flybe in the UK, and we can expect that the sectors will be very deeply impacted and will also be one of the drivers of the rise in bankruptcy. Another sector that will be the driver of this bankruptcy is the energy sector, and more particularly the US and Canadian oil sectors. So as you can see, because of the COVID-19 crisis, oil prices plummeted quite dramatically in 2019, falling from above 60% at the beginning, from above $60 at the beginning of the year for a barrel of WTI, and even going through negative prices in late April. So because of this fall in oil prices, a lot of US and Canadian energy companies have been forced to cut into new drillings and to cut investments, to cut their productions. The US production has already declined by 15% since late February, and considering the level of debt that many US shale producers have taken over the past 2 years to increase production and to allow the US to become the world's leading producer of oil, a lot of them are going to be forced to file for bankruptcy, and we've already seen this rising trend in bankruptcies in April and May, with with diamond drilling company filing from bankruptcy, for instance, Whiting Petroleum also filing from bankruptcy. And you can see from the right-hand side chart that we expect that in 2020, that just the exploration and production companies in the US and Canadian oil and gas sectors are expected to reach a record level in 2020, and they will probably continue to increase through 2021, as many of them have been forced to cut on spending and then to cut on productions and have negative cash flows at a time of financial stress. So these three sectors that I mentioned are among the sectors that we have downgraded in our last barometer, obviously, and are because they are the worst hit, and it's better reflects the impact of this COVID-19 crisis. But you can see that we've also downgraded other sectors. Most notably, we have also downgraded the automotive sector. So just as Carlos mentioned, the double whammy of the impact on supply chains, but also the impact on demand is putting ill for the sectors in 2020, and that's why we decided to downgrade the sector in both the US and Canada to very high risks. We also decided to downgrade the US construction sector because of the freeze on construction activity in many states that took place, that is going to have an impact in the next few months, and also because we expect lower sales in spite of the lower interest rates and mortgage rates that we have because of the Fed policy response. So that's the sectors that we expect to be the drivers of these rising bankruptcy and to continue to feel the impact of the crisis through the rest of 2020 and 2021. So even though the worst may be behind, that will be my concluding remark, we will still hear about COVID-19 and the impact of COVID-19 for a long time. So I will. That concludes my bit. I will now hand over the mic to my colleague Patricia, that will detail her scenario on Latin America. Thank you for your attention.
Hi, good morning, everyone. So thank you, Ruben. Thank you, Carlos, too. So after hearing about the evolution of the COVID-19 in Asia, where everything started, and then also in United States and Canada, now we'll see the spillover effect on the Latin America economies, as well as the evolution of the COVID-19 in the region. So as Carlos previously presented, we released the last week the new country risk assessment, so the changes from the first and the second quarters. We downgraded many countries everywhere. So considering Latin American region, we downgraded 11 countries. So take into account the largest economies, we downgraded Argentina, Brazil, Ecuador, and Mexico. Moreover, we also downgraded many countries in Central America and Caribbean. And the reason it could be explained in these two charts here. We had there what we could call a bad duo, a higher dependence on remittance and on tourism. So as you know, tourism is highly impacted by the COVID-19 crisis. And of course, it will not rebound shortly, would be very gradual as we still don't have a vaccine so far. So when we take into account the travel and tourism total contribution to GDP in many of Latin American countries, we see that it's really high for Caribbean countries especially. And another point regards the remittance, because in these countries we have many citizens that works abroad, especially in the US. And as Ruben mentioned, we saw this strong increase in unemployment rates in the US. And of course, this will also impact remittances to their countries. You know, even if we take into account some exchange rate depreciation, we see that the net effect would be negative, hurting the economies. So here we have our GDP growth forecast for Latin America that we have reviewed. So as Carlos mentioned before, our forecast for the global activity this year, we are expecting a contraction of 4.4% of GDP. So we are expecting a broader recession in Latin America. We're expecting the average GDP of Latin America to drop by 6.5% this year. And we're also expecting a partial rebound in the next year, so of 3.1%. So it's worth noting that this is different from our global scenario, because for our global scenario, we see a rebound of 5.1 next year, so totally covering the loss this year. So for Latin America, we only expect a partial recovery. And take into account the largest economies here, well, Argentina was already suffering and we were already expecting a third year of recession in a row, but of course the COVID-19 just deteriorated the growth scenario. So we're expecting for the next year a partial rebound from minus 7.5 to 3.5% growth for the next year. In Brazil, we are kind of optimistic early this year because last year it was approved the much needed social security reform, which is very important for the fiscal side. We're expecting a kind of 1.5% growth, but with the effect of the COVID-19, we're now expecting a 6.5% contraction and a partial recovery of 2.8% for the next year. For Chile, we are seeing a contraction of 4.5%. It's worth noting that, as you know, Chile is a very open economy. It's also very reliant on copper and copper prices. And of course, we're strongly hit the crisis. But on the other hand, mining activity has been considered as an essential activity, so it continues to work. Also, there's a higher fiscal space, so the government has implemented, together with the central bank, also stronger measures to try to smooth the negative effects on the economy. So that's why we are also expecting a stronger rebound next year of 5.3%. Colombia was doing better. Was doing well, growing above the average before the crisis. The economy grew by 3.3% last year, was well until February, and then also impacted by the crisis, but also we have the effect of lower oil prices here that hits the economy. So we're expecting a rebound of 3.7% next year. For Ecuador, actually break even last year. They already needed to adjust public expenditure. So now they also don't have space. They have limited space for implementing fiscal stimulus measures. So we're expecting a strong decline of 8.5% this year and a partial rebound of 3.5% next year. For Mexico, actually we had a marginal recession last year of 0.3% of GDP. So the economy was already lackluster early this year, was already in a recession. So not only we have the impact of COVID-19, but also the government has tried to continue with a very limited fiscal stimulus measures, stubborn as policies. And we have the effect of the U.S. recession, the high reliance on the U.S. For Mexico, that also hit the economy. And finally, Peru. Peru was expecting a contraction of 5% this year, with a rebound of 5.2% next year. Peru, also similar to Chile, they also are implementing higher fiscal stimulus, higher space for fiscal measures. So finally, here we have the barometer assessment for Latin America. So again, similar to the countries, the other regions, we also downgraded many sectors in the many assessments in the last 2 quarters. So we downgraded actually 16. Yeah. Actually, we already had many assessment that was already in high risk because of the recessions already there in Argentina and Mexico, also with the strong protests in Chile later last year. And finally, in Brazil, it was a little bit better in assessment, but we also made this adjustment. So the sectors that registered the highest number of downgraded were the automotive industry, the energy industry, ICT, the textile industry. So here we have the evolution of the COVID-19 cases in Latin America. So different from other parts like in Asia or Europe, or even the aggregated figures for the US, where we start to see the number of daily deaths going down. This tendency is not yet clear for Latin American countries. So we see that here we have, the exception is the case here of Ecuador, but also we had 2 strong peaks here because of delay in registering cases, and also to compute the figures. So also giving this idea of a decline, but generally we started to see some loosening mobility restriction despite still a very high number of cases. So here we have the Astringency index. Basically, this records the strictness of lockdowns policies in each country. So we have here for the major Latin American economies. So basically, we started to see some loosening, very gradual loosening of mobility restriction measures, especially in early June. So this is a reality in many markets. So in Brazil, Colombia, Ecuador, Mexico, and Peru. Actually, Argentina, and Chile, they also tried to do the same. They started to reduce, but then the number of cases starts to go up again, and they had to set back and to increase the restrictive measures. So what we could say is that the tendency is that we will continue to go down, to see the losing of these measures, but we will face this volatility. So probably some other countries will have to set back a little bit and then to start to go down again as we see a large number of cases in the region. So here we have, here we have the high frequency indicator, so a tracker of activity for retail and for recreation mobility, actually for leisure, so park, people going to libraries and so on. So we have the evolution since our baseline point, that is before the COVID-19 hitting the region until nowadays. So we see, of course, a strong decline in activity, but it's worth noting that, for instance, Brazil and Mexico, that they were more resilient. So they don't decline the same speed, the same rhythm than we saw in Argentina or in Peru. So they are more stricter in terms of complying with the mobility measures. Anyway, as we saw before, we're starting to lose the measures, but so far it's not yet very clear in this mobility tracker. These figures go until the first week of June, so we probably will see this rebounding in the upcoming figures. So another point, very important, that was mentioned in our last webinar was that in March we observed a record high capital of outflow of emerging market, not only Latin America, but generally of emerging markets. So it was a record of $83 billion. So it was even higher than the peak of the 2008-2009 crisis. In Latin America, it was an outflow of $16 billion in March, but then we started to see some improvement in April and May. So considering the Latin American market, this was also reality. So with an inflow of $5.5 billion, so kind to reducing the losses of March, and basically going to the bond markets. There's a higher resilience going to the bond market than to the asset market. Similarly, when we look to the sovereign risk, also we registered the peak in March, and then it starts to go down. So especially since May, and here we have the 5-year CDS for the Latin American economies, and just the exception is Ecuador, where we take into account the JP Morgan EMBI index. So the higher, the greater the risk. So we have the evolution since early this year, and I would separate this in 3 groups of countries. So higher risk, we have Ecuador and Argentina. So both countries, they were already at higher risk, but they are facing debt renegotiation. So Argentina, they are set a new date now for next Friday. They are trying for a long period to renegotiate their debt in the foreign currency. While Ecuador, they started more late last year with agreement with IMF. So now the situation, of course, deteriorated with the COVID-19, and they said that they will send a proposal until in the coming weeks, and set a due date until August 15 to try to solve this, to get to an agreement with bondholders. And of course, the situation only deteriorated with the sharp drop in oil prices. So these are the countries where we have the higher sovereign risks in the region. Then we have another group of countries where we have Brazil, Mexico, and Colombia. As we can see here, Brazil was the risk associated with Brazil was a little bit higher early this year, but they were kind of similar. But then since the COVID-19 outbreak, there was kind of the gap between Brazil and Mexico and Colombia has increased, has widened. And the reason behind that could be first, because Brazil has announced higher fiscal stimulus measures. On the hand, of course, this is good to try to smooth the impact on the economy, but on the other hand, we know that this will impact the public debt that's already high. Another point here is that we also saw some political sparks in Brazil, so this could also have contributed to this figure. And finally, the third group of countries, where we have Peru and Chile, both countries still with a higher risk compared to early this year, but as they have a higher historical commitment of fiscal discipline, they still are assessed as a better risk in terms of sovereign risk. Finally, this moderation in capital outflow, together with some improvement in commodity prices, also helped to reduce the year-to-date losses in the exchange rate market. So we have the evolution of exchange rate since early this year. Well, the Brazilian real was the currency that was the hardest hit currency. So not only due to the reasons that I mentioned before, but also it needs to take into account the sharp reduction in our policy rate, Selic, so reducing the incentive for sending or investing in Brazil. So together with Brazil, we also have a depreciation of 17% in Mexico, 16% in Argentina, 14% in Colombia, 5% in Chile, and 4% in Peru. So it's also worth noting that in Argentina, this figure is artificially low because, as you know, Argentina has increased capital control since last year due to the the limited international reserve, foreign exchange reserve. So they continue to increase capital controls in the country. So when we look to the black markets, to the parallel exchange rate markets, the gap between the official rate and this parallel market is around 70%. So it's only increased. This means that even with this big difference, people are still trying to assess the black markets due to the high uncertainty in the country. Finally, here we have some lead indicators for economic activity in the second quarter of the year. So we expect the worst of the recession in Latin America to be observed in the second quarter of this year, of gradual improvement in the following quarters. But it will depend from one country to the other if this will be the worst month in April or May. So here we have in the first chart the Purchasing Manager Index for the manufacturing activity until May. So we have for Brazil, Mexico, and Colombia. In these three markets, it registered a strong drop since the COVID-19 outbreak, reaching the weakest point in April, and we already start to see a kind of rebound, although it's still well below the 50% thresholds which separate contraction of growth. So this means that probably we'll start to see a very gradual improvement ahead. On the other hand, in the second chart, we see the behavior of consumer confidence index. This is for Chile, but it could be for other countries as well, because it would show a similar behavior anyway. We see that that consumer confidence takes longer to recover. So this goes in line with what Krause previously showed regarding the recovery of industrial production and retail sales in China. So it's easier to return to production while demand takes longer. It's more gradual to recover as we had higher unemployment rate, as uncertainties remain very high. So people are trying to save more. So we see that this is also being reflected in Latin America. Finally, here we have the measures, the fiscal monetary measures taken so far by the largest economies. So basically the fiscal measures, they aim to of course increase the expenditures in health, but also to help the informal market, because as you know, Latin America job markets is very informal. We have roughly 50% of the jobs are informal, so they are very vulnerable in this time. Also measures to try to protect the companies, also to protect the formal job market, So this varies from one country to the other. So as I mentioned before, Peru and Chile, they have higher fiscal space, so they are also implementing higher fiscal package. And Brazil, despite the limited space, they are also with high stimulus measures. On the other hand, we have Argentina, Colombia, and Mexico with more limited fiscal measures. In terms of exchange rate of interest rates, they continue to slash interest rates in the last month. So now we have very limited space for continue to reduce. Actually, it's already in real terms. So excluding the effect of inflation is already at marginal negative levels in Peru, in Chile, and in Colombia. And in Brazil, due to the high fiscal deficit, the central bank has analyzed that they cannot go to a negative interest rate. So actually, today they will meet for announcing the new policy rate. They will probably reduce to 2.25% and then remain in 2.25. So we also see the central banks taking measures to try to assure liquidity, so like reducing compulsory rate. But of course, in a moment where we have seen a higher risk aversion, sometimes it is not enough to assure that this will reach companies that will assure a better interest rate. So some central banks in Latin America are starting to take into account measures used in the previous crisis and used now again in developed markets. So the quantitative easing, so buying public bonds or corporate bonds. So Chile and Colombia started with these measures, mostly in Chile, but also a little bit in Colombia as well. Brazil Central Bank was authorized by the Congress, has not started yet, but it's also a tool that could be used. So it's a way to assure that to help to reduce interest rates and help companies in the final aim. So it's another important point going on here. Here we have the behavior of foreign trade for the largest economies. So actually last year, foreign trade was already suffering, first because of weak growth rates in the region, but also because of the trade war between China and in the US. That also have some negative spillover effect worldwide as a very globalized supply chain. So now, of course, the scenario only deteriorated. So when we look to export and import figures, both are declining in all markets. So we have here the last month figures and make a year-on-year comparison as well as the accumulated figures. What we can see here is that the last month the decline was harder than in the accumulated, so it's going down, so it's deteriorating the last months. Yeah, exports as well as imports, and it's also interesting to observe different kind of behavior. So, like we see the case of Brazil and Argentina, which they are more dependent on exports of the agro products. Of soya, but also other products that are more resilient. So the decline in exports are not so high as in other markets. Like in Chile is another example. Chile, there's this high reliance on mining. Of course, it is hit by the lower international prices, but it's not so. The impact is not so high due to the fact that the mining activity was considered as an essential activity in Chile. But on the other hand, we have the example of Ecuador and Colombia that's starting to be highly impacted by the effect of lower oil prices. Also in Colombia, it's worth noting that the main products are oil and also coal. That's also hit by the prices are also hit by the crisis. So a strong decline, while in imports has remained kind of resilient. So this is a kind of a risk. And in Peru, it's interesting to notice that they have a kind of product export baskets that's similar to Chile, but the difference here is that in Peru, mining activity was not considered as essential activity. So that's why it's registering a sharp decline, while in Chile, it has remained kind of resilient. And finally, Mexico exports start to be are hit now, and especially with the strong decline in activity in the US. So this was also driven by the lower manufacturing exports. Finally, we are all talking about the COVID-19 effect on the economy, but it's worth to remind that in Latin America, we already had a lot of pre-existent illness before being hit by COVID-19. Also during the crisis, new risks emerged. So it's worth noting, it's worth reminding the main risk per country. So in Argentina, we say the public debt, as I mentioned before, so they have a new due date now next Friday to try to solve. Meanwhile, as international reserves are going down, they start to further restrict access to capital, to access to dollars, yeah. So this is also impacting companies, could impact economies, companies exporting to Argentina. Actually, we already saw companies already complaining about that, some delays in receiving because of the controls of central bank, and this could hit especially components of durable goods, yeah, because others like fertilizer that are very important for the agricultural activity, or intermediary goods that will be used for the industrial process in Argentina, they have a higher resilience, so this is a risk to be monitored. And finally, we had an agro trading company, a very well-known company there that was in Chapter 11 protection, and that the government decided to nationalize. So this was very criticized by the business community, and is a
Thank you, Patricia. Okay. Thank you, Carlos and Ruben, also for your insights in each of the regions. I think it really has given us an important overview in terms of where we stand in the economic context and how we will be advancing facing the upcoming months. For those of you who haven't met me yet, my name is Hattie Angeraldo, and I am the Regional Commercial Director for Latin America. I would like to start now with the questions per regions with Asia. Carlos, starting with the first question, what do you think are the most impacted sectors or affected sectors in the business insolvencies?
We expect to see, as I mentioned earlier, not yet seen full impact of the lockdown on business.
Carlos, we can't hear you too well. Can you please repeat?
Yes, I will try to speak louder. We have not yet seen the full impact of lockdown measures on all of the sectors in Asia. So we are expecting to see more involvement going forward. The sectors that will be impacted the most include transportation, retail, and automotive for the factors that I mentioned previously. They are either been disrupted greatly as a result of measures, or they are sectors that experienced an increase in 2019. Having said that, the situation can vary significantly from country to country in Asia Pacific. So it's also interesting to look at the results of our sector assessments for different economies in case you are interested in a specific sector in one of the countries beyond the general trend.
Carlos, unfortunately, the sound is not as good as we expected it to be. So what we're going to do in your case is send the questions out to you and then get your response so we can share with all our audience. So I'm going to turn now to Ruben. For North America, do you feel that we are already experiencing a second wave and our retailers are going to be really impacted by it?
So is it a second wave or not? As I mentioned, the situation is very different from state to state. So I think that from now on, and that many state governors will be very cautious in going back into shutdown. So it might be it might be a bit early to say that it's a full second wave, but for some countries it's definitely very worrying, and it's gonna be definitely difficult for retailers to if this resurgence in new cases is confirmed, especially in the places where it's already increasing, because it will mean that some stores may decide to close again, and that consumers will grow cautious again in going back to retail stores. So that's why I think might be too early to say that it's a full on second wave, but that's definitely there are definitely some worrying signals.
Okay, in terms of the perspective for the rebound of tourism, what is your opinion for the U.S.?
Well, it will be difficult because there are still some travel restrictions in place, and so the summer is probably going to be difficult. The rebound in tourism will depend a lot on seat capacity and social distancing measures that are going to be implemented by U.S. airlines as they as international travels recovers. Will probably keep seat capacity at a low level. So there will definitely be a lead on the recovery in the tourism sector in 2020 and even going into 2021. So I think we should expect the recovery to be very slow, and especially many tourists will avoid international travels. So on the domestic tourism front, we might see a more rapid pickup, but for the international travels, it might be a longer way to the recovery.
Okay. Do you think there's going to be a sector or specific sector with growth perspective for the second semester in the U.S.?
So growth, it's difficult to define growth in currently because as Carlos mentioned, considering the impact, we're gonna have a very huge base effect in many sectors. So definitely in almost all sectors of activities, we're gonna see a rebound from the lows of March and April. The main issue that we are gonna have is that most sectors are still going to be at a lower level than they were before the crisis at the end of the year. So which sectors are going to avoid this? Well, hopefully the food and the agri-food sector in general could recover soon, but it will depend a lot on demand from restaurants. So that might still be constrained, but the impact will be definitely lower. The pharmaceuticals industry, even though impacted, also well, if the supply chain disruptions is in the next months, will also be less impacted. So these are the sectors that are a bit more resilient, but again, we will be coming off a very low base after what we experienced in March and April. So any growth that we will see in the second half of the year will have to be carefully analyzed to avoid any misinterpretation of the figures, because we won't be back to where we were before the crisis.
Okay, definitely. Thank you, Ruben. In terms of the relation with China and the agreement there and the second wave, or the possibility of the second wave, and the evolution, where do you think we're going towards the relationship with China in the U.S. particularly?
So I briefly mentioned this, but we have the U.S. elections in less than 5 months now. It's scheduled on November 3rd. And the rhetoric of the current U.S. administration toward China has been mounting, and it seems that we're going to see an escalation in tensions in the months going through to the U.S. election. The main issue it's going to be on trade, with potentially more tariffs being implemented, potentially the effect of the phase one deal being cancelled. So we will have to monitor what happens to this phase one deal, because China is probably not going to meet its commitments, but will the U.S. decide to end the relationship there, or to try to give China more time? We will see that. And as I mentioned, and I think that Carlos will also elaborate, there's also a very high risk that the U.S.-China trade war becomes more U.S.-China tensions, and that in addition to tariffs that have already increased quite substantially in the past 2 years, we're going to see more protectionist measures with sanctions targeting Chinese firms, with more sanctions trying to slow to going through to other topics than trade, to going on investment as well. We've seen that the administration has advised to restrict investments, some investment for some retirement funds on Chinese equity. So these are also what we are worried about. I believe Carlos will also want to elaborate on this issue because there is a lot to say, and there are a lot of point of tensions in the relationships, and in the next 5 months, at least until the elections, I don't see these tensions easing.
Okay, thank you very much, Ruben. Now moving on to Latin America and Patricia. In your opinion, what would be the industrial sector mostly affected by the lack of export coming from China due to the second wave, taking into account that most of the Chinese supplies are coming into our region and are very slow? So, Patricia, can you elaborate there?
Well, actually, we are already trying to do this exercise early this year, yes, when we thought at the time that this would be restricted, the COVID outbreak would be restricted to China. So at that time, we saw that the higher resilience of the product that had a high resilience of imports coming from China are the auto parts in the automotive industry or in the ICT sector as well, and the textile industry. So if we have a second wave in China, this would be the sectors of a highest impact. But it's also worth noting that, for instance, the automotive industry and the textile industry is already one of the most affected in terms of demand as well. So demand is not going to be higher as it was early this year.
Okay. What would you say is the most affected country in our region with the possibility of the big depression here?
In terms of depression, I don't see that we're going to get to depression. Our baseline scenario is that we will get a very gradual recovery. So as I presented, we believe that next year, although we're not going to see a total recovery of economic activity, we will have some a partial recovery, and this will continue in 2022. So, and also we have a scenario that we expect to have a vaccine for the next year. So we'll get to depression. No, but of course, some markets like we had the debt renegotiation going on in Argentina and Ecuador. So I see that as a high risk, also because of very limited space for fiscal stimulus. No, so are other points to be mentioned.
Okay, what would you consider are the main sectors that could be attractive for the second semester and for 2021?
Well, for this year, we believe that the sectors that were more resilient now will continue with this behavior, like food. Of course, we should continue with a similar behavior. The pharmaceutical industry could also increase as well for the second quarter. And I see that for durable goods like automotive industry or the ICT industry, I believe that this rebound would be more for the next year, okay? And starts very gradual this year, but more to next year.
Okay, could you give us a brief on Uruguay and sovereign risk?
Yeah, actually, Uruguay, they already had a high fiscal, high public debt, and growth was also lackluster in Uruguay before being hit by the COVID-19. But they are doing quite well compared with other countries in the region. So it was very interesting because the president already took office in March 1st. So it was really a very challenging moment to take office. And he already, since the start, they put very restrict measures. So this helped to contain the infect, so it's not increasing fast in Uruguay. So this also helped during the recovery. He has also been able to improve his popularity in the country. So I see that they are not in a very bad situation from the fiscal side. Of course, it will go down during these months, but it's not the same level than other countries. And also important to mention that one of the reasons that probably helped Uruguay to register lower numbers compared to neighboring economies is that there the density, national density is lower now. So this also helps in moments of COVID-19.
Okay, Patricia, I have to go back to Ruben because I have an important question for him. Ruben, are you there?
Yes.
Okay.
Yes,
there's a question regarding the stock market in the U.S. It seems to be working at the same level as it was before COVID-19. Could you explain a little bit why this is happening? Is this can this be permanent in the terms of the upcoming months? What is your opinion on that?
The equity market's been very dynamic in the U.S. and recovering to its pre-crisis level from last week. So that's something that's a bit surprising, considering when we looked at the earnings, the earnings released in Q1, they were very negative, and most companies were saying that they were expecting the impact to be even bigger in Q2. So this recovery is definitely at odds with what we're seeing on the economy, which is still lower than it was at the beginning of the year, despite the recovery. It's also at odds with what we're going to see for companies in the next month with the release of the Q2. So I do think that there's a lot of optimism. I see that this morning they're rising quite rapidly in response to the latest retail sales figure. But again, you can see the glass half full. For sure, they increased by 17.7% from the previous months. But you can also say that they're 6.1% below their May 2019 levels, and more importantly, they are still 10% lower than they were before the crisis. So that's why I think we're going to see a lot of volatility this summer on equity markets, because there is definitely a mismatch between this level of economic activity that is still lower than what it was before the crisis, and equities and stocks being at levels similar to what they were before the crisis. And we can see this mismatch and this odd response of the market in some very strange rise in the equity markets of some companies that have filed for bankruptcy, including Hertz or JCPenney, which have seen rise in their stock value despite filing for bankruptcy. So there's definitely something strange going on in the market, and it has probably gone a bit numb because the U.S. market has probably gone a bit numb because of all the monetary policy support that has been thrown out and the search for yield. But so that's why I anticipate some more volatility on equities in the months to come.
Okay, thank you, Ruben. And our last question, moving forward to Patricia again. It seems that we haven't even overcome the first wave, and many are talking about the second wave. What do you expect for the Latin American region in regards to a possibility of a second wave, economic context, and that pressure? Thanks for your opinion, Patricia.
Well, I think that in Latin America, it will kind of mix the first wave or second wave. I think that we will have this first wave, yeah, and then a gradual return. And I do not expect a second wave, as we are taking longer than other markets to start to be able to flatten the curve. So I think that we'll have this first round and then gradual returning, and then we'll have probably get to a solution to that, to a vaccine or a very efficient medicine. I do not expect a second wave like we had in other markets that were that succeeded in reducing the curve, flatten the curve.
Okay, thank you. Thank you, Carmina, Oscar, for opening up our event. Obviously, Carlos, Patricia, and Ruben for these presentations. And we will be sharing with all our audience these presentations, and the information regarding your questions will be answered in this week. So keep in touch, join us at our website, and we will be sharing future information and webinar events through our website and by mail. Thank you, everyone. Take care and have a good day, good afternoon, or good evening.
Thank you.